Have you ever wondered why your money doesn't go as far as it used to? Or how the entire economy actually works? Well, stick around for a quick and clear guide to basic economic terms explained in simple, everyday language. Do me a favor, hit that like, subscribe, and notification bell before you leave. Debt is a fundamental economic term that refers to the amount of money borrowed by one party from another, with the agreement to repay it, and it's often with interest. On a personal level, debt includes things like credit card balances, auto loans, and mortgages. These allow individuals like you and me to make significant purchases and manage our cash flow. For businesses, debt is a vital tool for financing operations, expanding production, and investing in new ventures. This can come in the form of business loans or corporate bonds. Governments also rely on debt to fund large-scale projects and public services. This is typically done through the issuance of government bonds. Debt, when used responsibly, can drive economic growth by enabling spending and investment. However, it's crucial to maintain sustainable debt levels to avoid financial instability. Understanding debt is essential for grasping how economies function and grow. It's a powerful tool that, when managed wisely, can lead to prosperity and development. A market economy is an economic system where decisions about production, investment, and distribution are driven by the forces of supply and demand. In a market economy, private property and freedom of choice are key. Individuals and businesses have the right to own assets, and they make decisions based on personal interests and market opportunities. Competition is at the heart of a market economy. It encourages innovation and efficiency, leading to better products and services for consumers. Prices in a market economy are determined by supply and demand. When demand increases, prices rise, signaling producers to supply more. Conversely, when supply exceeds demand, prices will fall. This system drives economic growth by promoting investment and consumer choice. However, it's crucial to balance these elements to avoid issues like income inequality and market failures. Understanding a market economy helps us see how individual choices and market forces shape our economic landscape, leading to growth and innovation. In economics, capital refers to the assets used to produce goods and services. This includes both physical assets like machinery and buildings, and financial assets like money and investments. Businesses invest in capital to grow, expand production, and improve efficiency. This investment drives economic growth and innovation. Financial capital is crucial for funding new projects and business activities. It includes funds raised through the stock market, loans, and investments. Access to capital is key for entrepreneurs to launch and scale new ventures, turning ideas into reality. Capital plays a vital role in economic development. By investing in assets, businesses can innovate, create jobs, and contribute to prosperity. Understanding capital helps us grasp how assets and investments drive economic activities, leading to progress and development. Thanks so much for joining me in part 2 of Economic Terms. There will be more to come, so for now, you can click on a video to your left. And remember, information is power.